On the surface, everything in the US stock market looks fine. Better than fine, actually. As of recently, the S&P 500, a key benchmark for the market, finished just 1.9% away from its all-time record high. For many, that signals confidence, strength, and a booming economy. But underneath that calm surface, something else is stirring. According to a recent report from MarketWatch, the market is masking a lot of AI turbulence. While stock prices for a few key companies have been soaring, another, much quieter corner of the financial world is sending a very different signal. It's not coming from a flashy tech CEO or a headline-grabbing company. It's coming from a single number. That number is the yield on the 10-year US Treasury note, and it's been steadily creeping back towards the 4% mark. So, what is really happening beneath the surface of this rally? And is this seemingly boring number sending a warning signal that most people are missing? To understand what's going on, we first need to understand what the 10-year Treasury note actually is. In simple terms, it's a loan you give to the US government for 10 years. In return, the government pays you interest. The interest rate on that loan is called the yield. It's often called the risk-free rate because it's backed by the full faith and credit of the US government, making it one of the safest investments on the planet. Because it's so safe, its yield becomes the bedrock for the entire financial system. It influences interest rates on everything from mortgages to car loans to corporate debt. Think of it as the pulse of the economy. When it's low and steady, things are calm. But when it starts to rise quickly, it means the pressure is changing. And right now, that pressure is building. A rising yield can mean a few different things, and that's where our story gets complicated. But the key takeaway is this: a significant change in this single number has the power to ripple through every asset, from the safest bond to the most speculative stock. To understand why the bond market is getting nervous, we have to look at what's been driving the stock market. The story of the past year hasn't been about the entire market rising together. It's been about the incredible performance of a handful of massive technology companies, all connected by one powerful narrative: artificial intelligence. This has created what analysts call a concentrated market. That means the gains of the entire S&P 500 are disproportionately driven by just a few of its largest members. When those few stocks do well, the whole index looks fantastic. But it also means the market's foundation is much narrower and potentially less stable than it appears. This is the AI turbulence MarketWatch referred to. The excitement is real, but so is the risk of having all your eggs in one basket. Now, let's connect this back to our rising 10-year Treasury yield. Traditionally, a rising yield can be a good sign. It can signal that investors are optimistic about the economy. They expect more growth and maybe a bit more inflation, so they sell their safe, lower-paying bonds to move into riskier assets like stocks. To entice buyers, the price of those bonds has to fall, which in turn pushes their yield up. It's like a seesaw. But that's not the only interpretation. A rising yield can also be a signal of concern. It could mean the government is borrowing too much money, flooding the market with debt. Or, more relevant today, it could mean that investors expect the Federal Reserve to keep interest rates higher for longer to fight inflation. This is where the anxiety for AI stocks comes in. High-growth technology companies, the ones at the heart of the AI boom, are very sensitive to interest rates. Their value is often based on profits expected far in the future. Higher interest rates make those future profits less valuable today. It also makes it more expensive for these companies to borrow money to fund their ambitious research and development. So we have two conflicting stories. One story says rising yields are a sign of a strong economy, which should be good for stocks. The other story says rising yields are a direct threat to the very tech stocks that are holding the market up. For months, the market chose to believe the first story. Investors focused on the incredible promise of AI and shrugged off the concerns from the bond market. But as the 10-year yield continues its march toward that 4% level, the second story is getting harder to ignore. The bond market, with its reputation for being the smart money, is quietly asking a tough question. Is the AI-driven rally truly sustainable when the fundamental cost of money is on the rise? It's a classic tug-of-war between a powerful narrative and cold, hard numbers. But here's the part that many people are missing. The signal from the bond market isn't just a simple conflict between growth and interest rates. It's pointing to something deeper. The anxiety is about the quality of the current stock market rally. By pushing yields higher, the bond market is effectively stress-testing the AI narrative. It's signaling that the foundation of the market's recent gains, built on just a handful of companies, is too narrow. The concern isn't that AI isn't a revolutionary technology. The concern is that the market's valuation of that revolution has become detached from the underlying economic reality of higher borrowing costs. The bond market is suggesting that if this small group of tech giants were to falter, there isn't a broad, healthy market to absorb the shock. So, why does this matter to you? If you hold a common S&P 500 index fund in your retirement or brokerage account, you might believe you are broadly diversified. But in a highly concentrated market, your portfolio's performance is more dependent on a few specific companies than you might realize. The AI turbulence means that your diversified fund may be carrying a hidden, concentrated risk you're not aware of. The health of your investments could be tied to the fate of the AI narrative in a way it hasn't been before. The catalyst that could prove the bond market right or wrong is just around the corner. Every new piece of economic data, every Federal Reserve meeting on interest rates, and especially the upcoming quarterly earnings reports from these key technology companies will be a major test. These events will provide concrete evidence of whether the AI boom is translating into the durable, long-term profits that justify current valuations, or if the anxiety signaled by the bond market was the smarter bet all along. In a market obsessed with the promise of artificial intelligence, the most human emotion of all, anxiety, might be the one telling the real story.